This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. Here's the lineup for today's show. We go first to Dave Sally of the Ottawa Business Journal, then to my chat with Matt Hendricks, and after the break we go to Ken Cordes, who is formerly Vice Chairman of Goldman Sachs Asia, for a two-part interview, and that continues after the news. And then on to David Prince, who is the founder and president of Harbinger Capital Markets Research. And to conclude today's show, Carl Moore of McGill University joins BNN, and he comments on what businesses need to know about working with millennials. And finally, Ashrath Damodaran, who is a business professor at New York University Stern School of Business, and he talks about Uber's growth. But first we go to Dave Sally of the Ottawa Business Journal. It's great to be joined by Dave Sally from the Ottawa Business Journal for our weekly update. How are you, Dave?
I'm very good, John. How are you?
Okay, getting towards the end of the summer, and the frost is going to be on the pumpkin pretty soon.
Well, that's for sure, John. But what can you do? You know, that's Mother Nature, and I don't mind the fall anyway. It'll be nice to get rid of some of that humidity and still hopefully have a few warm days.
Well, we can head to the Ottawa News, and Dave, this past week, a local property management company became the first of its kind in Canada to be certified as carbon neutral by Tree Canada. Nordstrom announced it is expanding its presence in the capital and a program looking for startups with the potential to go global visited Ottawa as part of a cross-country tour.
That's right, John. Well, let's start with Capital Concierge, whose efforts to go green are paying off. The Ottawa property management firm became the first firm of its kind in Canada to be certified as carbon neutral by Tree Canada, a national organization that helps Canadians plant and care for trees. Capital Concierge President Dan Freed says it's 2016 and trying to be environmentally friendly is, quote, the right thing to do. He says the company takes good corporate citizenship seriously, and it wants to be a leader when it comes to environmental sustainability. To earn the special designation, the company went through an energy audit conducted by Tree Canada to measure its carbon footprint. It then planted 442 trees near North Bay to offset its carbon emissions. Tree Canada President Michael Rosen says the audit looked at everything from the company's office space to its vehicle usage. It then calculated the number of trees that need to be planted to absorb those emissions. In addition to the trees planted in North Bay, Mr. Freed says Capital Concierge plans to plant more trees around the 20 properties it manages in Ottawa, as well as offering energy audits and recycling programs to the condo owners who live in those buildings. The company's office has also gone paperless. Mr. Freed says he also expects the move to have a positive impact on the company's bottom line. Mr. Rosen says more and more businesses are exploring the idea of going carbon neutral, and he expects that the new federal government, with its increased focus on climate change, will also help drive interest in going carbon neutral.
And Dave, there's more good news for shoppers who like Nordstrom. It announced it is adding another store in Ottawa.
That's right, John. The upscale clothing retailer says it plans to open a rack store in Ottawa that will offer lower-cost merchandise. The Seattle-based retailer says the Nordstrom rack location is scheduled to open at the Ottawa train yards in the fall of 2018. The 35,000-square-foot store will offer discounted items from regular Nordstrom stores, as well as products specially purchased for the Rack brand. This will be the second Nordstrom location in Ottawa. The chain opened a regular store covering 150,000 square feet at the Rideau Centre in March of 2015.
And finally, an Ontario university came to Ottawa this past week as part of its search for the next great Canadian company.
Yep, that's right, John. A new program at Waterloo's Wilfrid Laurier University is looking to turn some of Canada's best startups into global businesses. On Wednesday night, representatives from the program were in Ottawa looking for companies that might have the potential to go global as part of a cross-country recruitment tour. Kim Maroney is an associate dean at Laurier's School of Business and Economics. She says the Lazaridis Institute Canadian Scale-Up program is looking for the top 10 most promising young tech companies in Canada. She says Canada has a vibrant tech ecosystem with world-class startups already, but it has trouble turning those companies into large global enterprises. The program aims to help companies that have completed an accelerator program take the next step and continue their growth. Ms. Maroney says these startups lack access to three different areas: experienced entrepreneurs, global markets, and capital. The program will put founders in touch with people who have overcome these challenges and help them, quote, build networks that span the globe, as well as help them access markets and capital in the United States. So far, at least one Ottawa area company has already applied for the program, and Ms. Maroney says she expects there will be more by the time applications close on September 16th. She says she expects the average company in the program's first cohort to be 3 to 5 years old, with a run rate of around $100,000 a month, or another strong sign from the market that the company has the potential to go global.
To conclude, Dave, what is on the OBJ radar for the coming week?
Well, John, the Internet of Things is all the buzz these days, and anyone who wants to find out what all the fuss is about will have their chance later this week. IoT 613, Ottawa's Internet of Things Conference, features tons of workshops and speakers, and it takes place Thursday and Friday at the Canadian Museum of Nature. For more information and to register, go to IoT613.com.
Well, thanks so much for this update, and enjoy the rest of your day, and we'll look forward to talking to you next Sunday, 2 p.m.
Thanks, John.
And now to my weekly chat with Matt Hendricks. Great to be joined by Matt Hendricks, who is Senior Vice President, National Sales at Sprott Asset Management. Matt, I find you in Toronto today. How are you?
Very good, John. Yeah, I'm here with my family, visiting friends, and about to take in a Blue Jays game today.
Oh, that'll be great. Now, I wanted to just cover the week because we had a meeting with the Federal Reserve officials at Jackson Hole, Wyoming, and Janet Yellen, chair of the Federal Reserve Board, made one of her rather confusing speeches. It seems that the Fed are managing monetary policy these days with media rhetoric. I just wanted to mention that on Friday, after Janet Yellen spoke, the stock market had been up about 100 points, and it came down by the end of the day to down 50 points. Gold was flat when she spoke, went up almost $20 an ounce, and then closed the day unchanged. And I've been watching markets a long time, and if that isn't manipulation, I don't know what is.
Well, for sure, John. We've seen the central planners mess around with the price of gold, and honestly, they're running out of arrows in their quiver on that. At least they don't have the strong ability to manipulate the price as they used to, because banks like Deutsche Bank and Morgan Stanley have been caught with their hands in the cookie jar, manipulating the price. They've admitted it, and the gold cartels, and they paid the fines. And so, I remember Eric Sprott saying a couple of years ago that it's just going to be a lot more difficult for this covert slamming or controlling of the price now that the eyes of the whole world are on these people now. So hopefully, gold has had a great run this year. It is still less than $600 away from its all-time high, so it has lots of room to run. The gold stocks are going ballistic, but again, they're still 400% off of their 2011 highs. So, we're not saying to make an overbet in that sleeve, but you certainly need to be there, depending on what your advisor says your risk level is, anywhere to the tune of 5 to 15%, we would say.
Well, you said it, Matt. The markets are being managed by central planners and seem to have rolled over this week. At least they're not heading higher. And this, of course, is the season to be somewhat cautious because September and October historically are not great months for markets. And I just want to reiterate the rationale for having a defensive portfolio. You never know when lightning will strike, and it's very hard to define the exact peak of a market, and certainly with all this stimulus. But let's go to the equipment that you have for investors, and you wanted to talk initially about flow-through.
Right, John, and it was incredible the whole week, because all you saw was Janet Yellen is, quote-unquote, ready to talk about interest rate hikes. And it's just amazing how the markets trade off of these central planners on what they think they're going to say or not going to do or do. Anyway, it's very difficult for an investor to run a portfolio these days, and that's why we've always talked about having a solid, diversified portfolio that includes defense built in. For example, this week when the markets were down, our enhanced equity strategy, the John Wilson strategy, posted a slight gain. So you want to have things in your portfolio that have defense. You want to have some good dividend-paying stocks. You want to have quality, global, unconstrained fixed income, and certainly sleeves, energy, precious metals, which are just running with the wind so far this year.
And you want to have international diversification. I'm going to be playing an interview with Ken Cordes, who is actually a Canadian, but he was vice chairman of Goldman Sachs in Asia, and he was just commenting on the fact that he could see the Canadian dollar down to the 65-cent U.S. level because of the differential in interest rates. That is, Canada 10-year bonds are yielding 1%, whereas U.S. 10-year bonds are yielding about 1.55%, and that could put downward pressure on the Canadian dollar.
Right. You definitely want to have currency hedging in your portfolio as well. And there's no use having a stock or a fund that's up, the underlying portfolio is up 5 or 10%, but the currency kills you and you end up being negative. So you really have to make sure that the fund manager you're using manages currencies to the best of their ability. Nobody can predict the future, but they can certainly hedge and take away risk on the dollar.
Now, tell us about the flow-through fund for this year.
For sure, John. As we've spoken with before, flow-throughs are great investments for tax purposes. So it's a tax deduction first. So just consider a flow-through fund as an unlimited RSP. So anybody out there, and this is what I always say when I'm selling this strategy, if you're T4ing at over $200,000 a year, buying a flow-through fund, in our opinion, is a must. You get dollar-for-dollar tax deduction on this year's taxes, and in return, you get an investment in the resource space in Canada, which, by the way, is on fire. And we have liquidity. This year, the Sprott issues are we're calling them shorter duration. Usually it's a 2-year hold before we get liquidity. On this specific issue, it's going to be anywhere from 13 to 15 months. And I can tell you that our 2015 and our 2016, our first issue, these funds are up almost 100% just because of the rebound in the resource market. So the underlying investment, we think the time is right. But more importantly, it is a tax deduction off of your income, lowering your taxable income for 2016.
Now, if listeners, advisors would like to get more information from you on the Sprott strategies, and particularly the new Sprott flow-through strategy, give us your coordinates.
For sure, John. I'm always reachable toll-free at 866-299-9906. And always remember to visit Sprott.com. We've got great information on our website.
Thank you, and enjoy the game this afternoon. And I look forward to catching up again next Sunday at 2 p.m.
All the best, John. Have a great Sunday.
Okay, folks, coming up, a 2-part interview with Ken Cordes, who was formerly Vice Chairman of Goldman Sachs Asia. He's a renowned strategist, and he is advising the Trudeau government on how to restore relations with China ahead of the trip by the Prime Minister to Asia. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
We are back with our guest co-host for the half hour, Ken Cordes. And Ken, you have just wrapped up meeting with Morneau's Advisory Council. We're talking a lot about the takeaways and in particular what Prime Minister Justin Trudeau and Bill Morneau will need to communicate to China when they go there next week. Walk us through the thinking, the thoughts, and what they need to do here.
Well, my thinking on these issues is that if you go back to Trudeau's father, who in 1968-69 started negotiations with the Chinese to recognize Communist China. The Americans didn't like the idea at the time, but Trudeau thought that that's where we should go. And we then spent 30 years building this relationship, presidents and prime ministers going back and forth, big constituencies. And Canada was sort of the go-to country on a lot of things. Go-to country on wheat, for example. And we were very much in the discussion. I would say in the last 10 years, our relationship has gone pretty much in the other direction. Probably at exactly the wrong time, because in the last 10 years, China's gone like that in terms of role and influence and weight in the world economy and political system, and our influence has gone like that. So I guess the first thing that has to be reestablished is a sense of stability in the relationships. I mean, the Harper government was hot one day, cold the next, zigzag. We have to reestablish a certain predictability, a certain stability in that relationship. And I think we have to be very realistic. Catherine, China's too big to bully.
Okay.
They aren't going to change because we tell them to change. And they're too old to charm, right? So we're going to have to deal with fact with them. And the fact is that very soon they'll be the world's biggest economy. Even this year, when their economy is not doing well, they're providing 40% of total world growth. And we aren't really part of that
We're not
anymore.
even at the table. The number is $85 billion that we deal with
our
in trade.
Trade has fallen backwards, not gone forward. Our competitors love what Harper did because they're in there fighting for market share every year. The Germans, the Australians, the Americans. We've got to get back in the game and become credible again for the Chinese. So that's number one.
How do we do that?
Well, I think by reestablishing a dialogue where the Chinese respect what we think and we respect and understand what they think. I think number two, I think a big mistake of the Harper government was not from the beginning to become a member of the AIIB, the Asian Investment Infrastructure Bank. That bank will invest about $4 trillion in infrastructure over the next 10 to 12 years. And we aren't part of it. The UK's part of it, Germany's part. We aren't part of it. To me, that's a no-brainer to get on the inside on that.
How do we get in?
Well, we join. We make an application to join it. The Chinese, I think, are quite open to that. In fact, they've told me they're very open to that. So do other members of the Asian Investment Bank want to see Canada there. But we've got to make that decision. So what if the Americans don't like that decision? What's in our interest? That's what we got to... And, you know, the Americans will play their own game. We've got to play our own game. They're our biggest player. But our second biggest partner, if you look out over the next 20 years, is going to be China, and we're nowhere, and we've got to get somewhere.
In the meetings that the advisory team held, Morneau's advisory team held this week in Toronto, that you are a part of, was that one of the key topics of conversation?
You know, those discussions are, you know, I'm there as an advisor, so I usually don't discuss in public what I talk about with the people I advise. But I think anyone looking rationally at the situation understands that China is a very big part of our future, and we just have to come to terms with it.
You also talk about, and we've talked about in the past, oil and energy being key and critical to our economy. What needs to happen with that industry here now?
Well, I think we have to be quite realistic. I've noticed people are still talking about huge exports of LNG to Asia. This week, our trading company delivered LNG into Tokyo at $4.80, 1,000 BTU. The Canadian operations need $12.50 to break even. So none of those projects are going to happen anytime soon. So let's get realistic. We have a big feedstock in natural gas. How do we use it? Well, we could use it by creating a big, globally competitive, high-end petrochemical industry instead of just exporting this stuff with no value added. So I think we have to think more in those terms, and I think we have to get over it and start using Canadian oil across the country and build a pipeline
We need
network.
pipelines for that. We do. That's difficult to get done, Ken.
You know, a lot of things in life that are important are difficult to get done. But we have to do them. It doesn't mean you don't have to do them. It means you just have to work harder to make them and help people understand. That's the role of leadership, and we have a great communicator as Prime Minister. So, you know, that could be one of his big, bold initiatives. Speaking
of communicating and getting things done and things that are hard to do, going back to the relationship with China, Canadians and their viewpoint on China's human rights records, how much of an inhibitor will that be to the relationship and the change in the relationship that we talk about needing to take place?
I think that's an issue. And I think one of the roles of the Prime Minister will be to help Canadians think through those issues. You know, if you look at this in a perspective, if we were to go back to the 1970s in the middle of the Cultural Revolution and compare it to China today, I mean, the progress is just out of this world. You know, in the 1970s, people were being thrown in jail left, right, and center, right? People still get thrown in jail in China today, but it's an incomparably different situation. Private sector today is 70% of GDP. You know, back in the 70s, it was 0% of GDP. So this evolution will continue, but China will have its own system, and we aren't going to fundamentally change that.
How do you think they're going to react to that foreign tax on home buying in Vancouver?
You know, Vancouver isn't the first place to have a tax on foreign buying. Singapore has one, Hong Kong has one, the UK has one. And as we were discussing earlier in the previous segment, you can't handle this bubble in real estate prices in this country through interest rates. Because we can't raise interest rates, right? So we're going to have to adopt other measures on mortgages, on loan to value. Those things are going to have to, and maybe other people, other cities and other parts of the country will have to do the same. Toronto has a runaway market. And, you know, we're just going to have to deal with that and use measures that we haven't used in the past.
And also, we're going to get Ken's views on where to invest, given everything that we've just been discussing.
Okay, folks, we're going to the news. When we come back, part 2 with Ken Curtis, formerly Vice Chairman, Goldman Sachs Asia, and he is now the chairman at Starfort Investment Holdings, and he, of course, is advising the Trudeau government on improving relations with China ahead of Prime Minister Justin Trudeau's trip to Asia. In Catherine Murray's interview with Mr. Curtis, he will be discussing his investment strategy, which includes a bullish take on high-yield emerging market bonds. And then to Harbinger Capital Markets Research founder and president David Prince to discuss the widening spread between Canada and U.S. 10-year yields and why he sees a possible market correction looming. So stay with us. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
We are back with my guest co-host for the half hour, Ken Curtis, who is also chairman at Starfort Investment Holdings. Ken, we want to talk about how you are investing today, but let's first talk about what Starfort is. What do you own and what do you invest in?
Starfort, as the name implies, is an investment company, and we have 4 main activities. The first one, we have a private equity company, which invests only in China. It's doing great. We have one visible minority, that's me, and all the other guys all the other members of the team are Chinese. That's become a significant company. We now manage about $1.5 billion. Secondly, we have a corporate finance company, and for that, you know, we have clients on 5 continents. The third activity is an Asian frontiers investment market, invests in listed securities in countries like Pakistan and Iraq and Sri Lanka. And the thesis there is higher growth, lower multiples, discounted by whatever your, you know, liquidity, regulation, and all the issues. And the fourth company, and the biggest company, is a global commodities merchandising and trading companies. So we handle a lot of physical commodities. We're about 40% agricultural products, 40% energy, oil, gas, and so on, and 20% ores and metals, and we have a big warehousing business. To give you an example of the scale, last week we had 26 Panamax ships on the water just carrying grain around the world. So it's a big operation, and, you know, commodities is everything. It's politics, it's economics, it's psychology, it's contracts, whatever. It's the weather as well. So that's where I come from.
A lot of different aspects. So for our viewers today, what is the one key investment idea or thought that you would leave them with in terms of how to be positioned?
Well, how I'm thinking it for ourselves is, number one, structurally long the U.S. dollar. There may be ups, there may be downs, but as we look out through 2017-18, I see sterling going below 125 to the dollar. I see the euro going to parity with the dollar. I see the yen going back to 125 or even lower against the U.S. dollar. And as we discussed earlier, I see the Canadian dollar getting a little bit weaker than it has been earlier this year. Secondly, as I look at the world economy, I'm looking at a world economy that's going to continue to be slow. And central banks not dramatically changing policy. Japan may become more aggressive on monetary policy. The ECB basically has baked in another rate cut. Or not the ECB, the Bank of England has baked in another rate cut. ECB, I think, probably next month does a little more on monetary policy. I don't think the U.S. raises rates much, maybe once or twice over the next 12 months. So we're going to have lots of liquidity still flowing into the economy, but very little of it going to the real economy. Of the QE in the U.S., we estimate only 18% has gone to the real economy. So there's going to be huge amounts of money still available to flow into asset markets. That means asset markets are going to be liquidity driven and therefore volatile as money moves in and out. But on the whole, I think you'll see asset prices still go higher. At the moment, what I particularly like are high-yield emerging market bonds, government bonds. They've been on fire this year, and I think they still have more to go.
Okay, and just for Canadian viewers here, you think oil goes to 75-80?
Yeah, I think the overall demand-supply balance for oil is now starting to shift, and as so much investment has been chopped back. So I'm looking 2017, 2018 to 75-80 a barrel.
Okay, we will leave it on that note. Ken,
Cheers.
Great to be with you today. Thank you very much for being with us. And in Canada, enjoyed the conversation. Thank you.
And now to David Prince, who is the founder and president of Harbinger Capital Markets Research. It's always worth listening to David because he has a very good and realistic perspective on the markets.
As the prospects of a rate hike from the Federal Reserve grow, the spread between Canada and the U.S. 10-year bonds continues to grow as well. For more on this, Harbinger's David Prince. Two central banks moving in different directions.
Yeah, I think it's very funny because what's happened is, in the case of Canada, ever since 2013, we've had this big outperformance of the Canadian bond market to that of the States. Well, a lot of that has to do with the weakness of the Canadian economy as well. So when you put it in perspective, in the case of Canada, as I alluded to earlier, 10-year bonds in Canada are still around 1%. What we did see today was an awful lot of volatility, and unfortunately I should have brought the intraday swing in that thing. But the reality is that people are starting to get a little nervous about maybe at some point within the next year we'll see a change. Well, the reality, of course, is that what we're dealing with is we've been feeding so much money into the system that these long-term bonds, longer term being 10-year, has gotten to the point where there's virtually no return, and you're making the bet that rates are going to remain obviously low for the next 10 years. Silly bet. Because what you're dealing with is an environment whereby you are seeing signs of the inflation. And here's what I want to get across to people. The inflation numbers, the way that it's being recorded by the states, is very misleading. And one of the things that they do factor in is the rent, which is different than housing prices, and starting to see an awful lot of housing prices. Well, let's take it into a Canadian realm. If you were to go and say, I'm going to include all the stuff that services that I pay the government for, and if I was to include housing costs, and now we're going to get some of that rental increase, the inflation rate is a hell of a lot higher than what is being stated.
Particularly in certain regions of the country.
And then if you add in this wind's electrical bills coming up, especially the increase next January, you can see how ridiculous the number is. So the average person is definitely suffering this big squeeze because the pressures of these forces that are not necessarily calculated in the headline CPI. And that's the dangerous path that we seem to be on. The bond market so far has been seeking out yield, and it's finally starting to price in some risk. That's the one to watch, the 10-year part of the curve. And the bottom line to me is that you're seeing that market on the U.S. starting to say, wait a minute, perhaps we're not going to get this long a period of exceedingly low rates.
Now, you alluded to this in the earlier part of our conversation. Ontario, Quebec, there's a lot of debt there. Ontario, the largest sub-sovereign debt in the world, I believe.
Yeah,
rates are low, so you can keep on borrowing, but that party can't go on forever.
Right, and I think it's important for people to understand that, Miss Wynne can talk all she wants, but the bottom line is we are paying an enormous price in this province to be indebted as we are. The market has long ago put a big premium to Quebec to be able to go or a discount rather, to go and borrow. Ontario now has definitely joined them. So we're paying over 100 basis points in the long end to borrow. And the simple solution obviously would be for the feds to go out and borrow and then give it back to Miss Wynne because it'd be a heck of a lot cheaper. So you think about it, 1 to 1.5% more expensive. This is going to be on top of $315 and maybe higher $1 billion. That's a lot of money and a lot of buildings that could be established and a lot of benefit for people that seems to be just being wasted away. So again, governments can't afford to go and have rates go up. There's a lot of refinancing, especially new financing, as the deficit expands. And this is why that we're going to see some real issues come up over this next year.
All right, I understand you have another chart for us that perhaps some people along this market don't want to hear, the odds of a correction coming.
Yeah, well, the problem for me, of course, is predicting corrections can be a very painful experience. But the bottom line to this thing, we've had many different times where we've had sharp corrections in this market, especially a year ago right now at this time. So what I'm talking about is getting some sort of protection. Now, I normally don't recommend levered types of ETF. But it seems to me that we're getting to the point where taking 5% of your portfolio and buying some protection, I don't care if it's in some form of optionality or something that relates to this ETF, but we're certainly looking like there is a chance for another one of these crazy trades, and those spikes on that last chart will give you a pretty good indication. There were some big moves, 70-75% moves.
Because those ETFs are basically bearish towards both the S&P 500 and the Dow, right?
One's a double, the other one's a triple. As I say, I hate using them. But if you get a correction, this is where you're going to get the biggest reaction to it, and therefore you're going to get a better rate of return. If you believe that the correction is going to be short-lived, in particular, you want something liquid. These are very liquid ETFs.
Okay, fascinating stuff. Always a pleasure talking to you, David. I was David Prince, founder and president of Harbinger Capital Markets Research.
Okay, folks, after the break, we go to Carl Moore of McGill University, and he takes a look at what businesses need to know about working with millennials. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
The so-called millennials are a growing influence in the workplace. In fact, these Canadians under 35 are set to become the biggest cohort in the population by 2050. Our next guest has strategies for how companies can adapt to ensure this group and their own businesses are better poised for success. It's part of his research for his forthcoming book. We're joined by a familiar face to BNN viewers. Carl Moore is a professor of business strategy at McGill University. He's based in Montreal, but we are delighted to have him here in Toronto today. Thanks for coming in.
My pleasure.
So you've done a lot of research on the millennials. In fact, you've traveled with a group of younger people. You've asked them for their views on their role, I guess, in the workplace and how they relate to supervisors and superiors. Is that fair?
Well, absolutely. I take an annual trip. This year we're going to Hong Kong and Manila and Boracay, last year Chile and Colombia. But I have 5 research assistants working for me who are 20 years old. So unusually for someone my age, I spent a lot of time with millennials. And I've also looked a lot at the research and done probably by now 1,000 interviews of millennials to understand where they're coming from and how they view the world.
I struggle with the breadth of that group. I don't see a lot in common between an 18-year-old who has largely one foot still in childhood and a 35-year-old who I expect to be a mature adult. What do you think?
Oh, absolutely. There's a great point there. And what I'm looking at is more working millennials that are probably more 24, 25, up to 35, so a bit narrower group. Okay. But even within that, when you ask about their younger brother or sister, they go, they're so different. And when you talk to a 20-year-old, their 15-year-old brother just lives in a different world from their viewpoint. But what I'm arguing in the book is that people over 45 with a university degree, people like myself, have a modern worldview. That's what we're taught. People under 35 with a university degree have been taught a postmodern worldview. They view the world so differently, therefore they've got to be managed differently as well.
Let's explain that. The term postmodern, what does it mean in this context?
Well, post after modern. So the modern worldview, some of the things I was taught growing up simply proved to be wrong. We thought science was the new messiah, would deliver us from all our troubles, but it turns out to create also global warming. Not so much science, but humanity's use of science, if you would. And so we were taught that there was truth, and there was a lot of truth, where today we see that people are taught there's much less truth. So students honestly believe their story is almost as good as mine, in spite of writing 8 books on a topic. Where they honestly believe that, and it's partly because that's what we teach them at McGill and U of T and other schools.
David? Do you think obviously this demographic, I mean, they're just moving out of their parents' basements and finally getting jobs. I mean, when they start having children and families and, moving out to the burbs and buying cars, do they not just turn into like we all are, or what happens? I mean, obligations of a job, and they have to start making, visa payments and et cetera.
Well,
I mean, what happens?
No question, there's an aging effect. There's nothing like a mortgage to focus the mind.
Yes.
The Royal Bank never once told me and said, Carl, it's been a tough month. It's on us. Like, it just keeps year after grinding away at you. Part of what we see, though, is that they're going to more and more of the alumni I keep in touch with are not going to buy a house in the suburbs like we did, but are going to live downtown. They're not going to have his and her matching BMWs. They're going to do, like our family does, car sharing. So it's a shift in terms of their values. But what I'm arguing is when you look at the world and the way they do, as a manager, as a leader, I've got to treat them differently. So, for example, simple point, I got to talk less, listen more, because they honestly believe their story is as good as mine. So if I don't listen, I'm a jerk. So I've got to spend more time listening to them. Now, the good news from a strategic viewpoint, this is what I've got to do in most industries to create strategies in a turbulent world. When I talk to CEOs, they say, I've got to listen more than I used to because I need to talk to the young people about how do we keep in where the world is today. So it actually is a hard-nosed business perspective as well as the fact this is the way they view the world. And if I don't lean into their worldview, I'm just going to be a bad boss.
I think this is the mentoring versus reverse mentoring. I think you've written in other articles, right?
Yeah, it's something where it's interesting. When I was young, it was about 98% one way. I probably was teaching something, but they never said that, and they would never talk about it. Where I have 5 20-year-olds working for me, 25 to 30% of the time, they're reverse mentoring me. Now, things like social media.
Things like what?
Well, social media, I mean, there's a no-brainer. But it's also things like what's hot, what's not, not only in terms of restaurants, but in terms of business and where it's going. And I'm much more apt to say, what do you guys think? Oh, well, let's do that then, than I would have in the past. Because the world is so changing so much. I asked I had the GM of Uber come to class, and I said to the students, anybody use Uber? Every hand goes up with enthusiasm. They're totally into the sharing economy beyond what I am, so they can mentor me about the sharing economy. So I can think of many examples where they are teaching me in a way I don't think I taught people 20 years ago when I was a younger person. So that's part of, you've got to reverse. Another interesting thing is feedback. So when I don't know if you've ever done an annual performance review. It's something hated by everyone.
Yes.
What they want...
360 reviews.
Oh, don't even get me started. But what it is that they want review almost daily. They want feedback from you. So in a meeting as a manager, I used to spend 10% of time thinking, hey, what do I tell you at the end of the meeting? Now I spend 25 to 30% of my meeting as a manager saying, what will I say to you at the end of the meeting to give you feedback? So even feedback is different for them. Now it's interesting because when older people hear about this, they go, I want some of that. I want feedback more.
Right.
I want to have you listen to me more. So the other generations will go, yeah, I want that too, but it's really the millennials, it's just so important to them, but it's becoming more important to other people as well.
We older people who have been in the working world for a long time tend to believe in things like showing up to work on time, working hard, and not complaining capriciously, understanding that you may have a day at work that is not your favorite day ever. Where do they stand on things like this?
Well, there's some truth to some of those things. But on the other hand, I spend a lot of time with them, and I think they're a great generation. So we've got to adjust part of how we approach them. And there's some whining and some silliness there for sure. No question about it. And you have to say once in a while, they call it work for a reason. It's not meant to be fun. On the other hand, when I talk to one-on-one with my students, which I do with all of them, have coffee, they're looking for something I'm passionate about. They're looking for something that has meaning. These are things that we want as well, but there really are, I see them changing jobs because there's not enough meaning. I see them changing jobs because they're not getting feedback. They're not getting help in their careers. So those sorts of things, we as older people are going to have to adjust how we do things. But you're right, there is some whining, but that's true of me. I whine sometimes. I bet you do.
How much of this is related to, I read an article somewhere that said some of it's related to actually the fallout from the financial crisis, that they watched their parents struggling with the fallout of that, and that their value system changed somewhat on the back of that. How much of that is it related to that, do you think?
I think that's an element. I hear that quite a bit. And they look at having multiple careers, not multiple employers, but multiple careers, and multiple employers probably within those multiple careers. So it's something where they just don't worry about, they're not going to work anywhere 35 years. Just ain't going to happen. Partly because they saw the man fire their mom and dad. So I'm never working for the man because I saw what happened. But I think the reality is we don't want to hire people for 35 years that much anymore anyway. And the industry is going to evolve to something different. And we've seen that in media. The media, I was at the Globe yesterday, is a very different place than 20 or 30 years ago. And the Globe and BNN's got to adjust with that. So the idea that you're going to do the same thing in 30 years as a young person is probably simply just untrue in the industry, let alone you as a person.
That's fascinating stuff, Carl. The book is not out yet, correct?
No, it's out towards Christmas, all being well.
Is there a title on it?
It's leading crossed out, managing crossed out, working with millennials the way they want to be worked with. And leading and managing are deliberately crossed out. Those are two strong words to use.
Okay, Carl.
And I know you do.
Thanks a great deal, Carl.
My pleasure.
Carl Moore is Professor of Business Strategy at McGill University.
And now to Ashwath Damodaran, who is a professor of business at New York University Stern School of Business. And he will talk to us about the phenomena known as Uber.
Uber reportedly lost $1.2 billion in the first half of this year. In fact, Uber has lost money quarter after quarter. With an emphasis on growth before profit, how can the ride-hailing company change this around? Well, New York Stern School of Business professor Ashwath Damodaran joins us now with more. Thanks so much for joining us.
Well, thank you for having me.
So when you hear a number like that, $1.2 billion in 6 months, what does that tell you about how things are going over there at Uber?
Well, it shows you that their ambitions are huge. I mean, the one thing about Uber that I think is always striking is they're a company that aims for the moon. I mean, they want to be everything everywhere. As you can see, even in their move that the previous story talked about, they want to be everything to everybody. And I think there's an upside to that, which is the price they've been at, the $62.5 billion valuation, the most recent one. The downside is ambitions are expensive. So when you see a loss like that, you can see how much they're trying to be everything to everybody.
And that seems to be the real key here. We were talking in the segment before this about the fact they're trying to get into the seniors business now. You have all these different apps where they'll deliver food by taxi and presumably Uber as well. Is it so the strategy is own everything and then worry about the money coming in?
Exactly. I mean, I think in a sense Amazon has ruined the world for business because Amazon created this model 20 years ago, right? Which is, I call it the field of dreams model, which is if we build it, they will come. If we build revenues, the profits will come. And let's face it, Amazon has been incredibly successful in that business model, not just in terms of becoming a $300 billion company, but in terms of destroying everything in its path. Here's the one thing I can guarantee you. Even if Uber never makes money, the traditional car service business is going to be destroyed in the process.
Destroyed in the process. Obviously, they're a huge disruptor, and they're putting a lot of money into trying to be that disruptor. How much runway do they have, though? How long can this go on, losing this kind of money?
I think as long as the capital providers keep providing them capital, there's no reason they have to stop. But in this case, the capital providers are both wide and deep. It's not the old just VCs. It used to be as a private business, which is what Uber still is, that your access to capital was limited by the fact that venture capitalists had only a certain amount of money and they were impatient. Uber's tapped into public marketplaces. Their most recent investment actually came from the Saudi Sovereign Fund, a fund that traditionally is invested in large, mature companies. So I think their access to capital is so wide and so deep that they can keep doing this for a while.
Does Uber have, I guess, what they call a big enough moat around it, in the sense that what if someone else just comes along while they're burning through billions and billions of dollars trying to own the world, tweaks it just a little bit, and steals all their business?
I think that is Uber's weakest link. I mean, I think that the difference between other companies that have built up it's not unusual for a young growth company to lose a lot of money. But if you're building into a business model that's defensible and sustainable, it makes sense. The problem for Uber is the existing ride-sharing business is not a sustainable business. It's a business with intense competition, with pricing pressure. I mean, I don't know about you, but I get at least a half a dozen emails every day from ride-sharing companies offering me deals. It costs me way less than it used to, taking one of these ride-sharing companies to places that I go to. So the underlying business is both unstable and easy to enter. And Uber knows it, its investors know it. And some of the actions you've been seeing Uber take, the driverless cars in Pittsburgh you might have read about, the partnerships with auto companies you might have heard about with Toyota, these are all attempts to build up moats. I don't know whether any of them will succeed, but you can see that Uber is aware of the fact that they have to build a business model that will deliver them profits once the revenues are there.
You mentioned some of the other ride-sharing services, including Lyft. What else do they need to do to sort of change the way they're working so this really works?
I think what made it so easy for them to grow has to change. What made it so easy for them to grow is to enter a new city. All that Uber had to do was hire a guy, put him in a hotel room, and that guy just sought out drivers who brought their own cars. What made it so easy for these ride-sharing companies to grow has to change. So what you're going to see is an increase in one or two things: switching costs, which means that once you become an Uber customer or an Uber driver, it'll become much more difficult for you to switch to a competitor, and they will figure out ways to increase these switching costs. And the other, and I think this is an interesting development, is larger capital investment in this business. Uber historically has never owned the cars. It's never hired the drivers. I think you're going to start to see that business model change where they actually invest in infrastructure and cars.
Does the driverless car completely change the landscape of this battle again when it comes along?
It does, but it plays into other companies' strengths, because if that is the way this business evolves, how does Uber compete with a Google or an Apple, which has better technology and $100 billion in cash to bring to the game? So it's kind of scary for Uber to enter that space, because in that space, I'm not sure Uber's strengths remain its strengths.
All right, fascinating stuff. Thanks for the discussion.
You're welcome.
That was Aswath Damodaran, business professor at NYU Stern School of Business.
Folks, thanks so much for joining us on Money Talk. I hope you enjoyed the show. Have a good week. We'll be back next Sunday, 2 p.m. I'm John Budden, and you are listening to 580